and welcome to Lesson 1, Working with the Tax Law. By the end of this lesson, students should be able to identify sources of the authority for tax law, identify the major sources for researching tax law, describe the process the IRS uses to determine which tax returns are to be audited, and identify the major tax penalty areas. Now we're only in week 1, but it probably hasn't escaped your notice. There's a lot of information to cover in these 8 weeks. You probably have come to the realization that you can't memorize the entire tax code and certainly not the entire body of tax knowledge. What is important is to know the different sources of information and how to find them when you need them. The tax law consists of statutes, also known as legislative provisions, administrative provisions, and judicial rulings. There are 2 broad categories of tax law. First is the law, and this would be the U.S. Constitution, anything that comes from Congress, and that includes tax treaties with other countries. Everything else is an official interpretation of the law. Now, tax law comes into existence the way any other law of the land does. A bill will originate in the House Ways and Means Committee, and then it goes to the House. If the House passes the bill, it goes to the Senate. The Senate considers that bill, may make some amendments, may pass a different bill. If the Senate doesn't pass the exact same bill, then the Joint Committee is charged with working out the differences. Once the Senate and the House approve that same bill that the Joint Committee has worked out, then the bill goes to the President for either approval or veto, just like any other law. In addition to that official law, there are administrative interpretations. These include Treasury regulations, and those can be legislative, interpretive, or procedural. It includes revenue rulings and letter rulings, revenue procedures, and determination letters, and we'll talk a little bit more about each of those. Now, the Treasury Department has legislative approval to propose new regulations, and when the Treasury Department is coming up with regulations, they follow the same general formula. So first they send out proposed regulations. Proposed regulations do not have the force of law, and they're for public comment. So the IRS puts something out there and says, practitioners, taxpayers, other interested parties, tell us what you think. Once that comment period has closed, the regulations may become temporary regulations. Now these have some authority, certainly during the period that they are in force. And generally temporary regulations don't change before they become final, but there is always the risk that if you rely on a temporary regulation, the piece that you're relying on may change before it becomes final, or it may never become final. And so while temporary regulations have some authority, they certainly don't have the same authority as final regulations. So when the Treasury Department has done its due diligence and made its decision, the regulations become final. They are part of the body of law. They can be relied on in tax research, and they are published in the Federal Register. In addition to regulations, we have revenue rulings and letter rulings. A revenue ruling is an official interpretation of the tax law, and it's limited to a specific set of facts. So if your client has a similar fact pattern, you may rely on a revenue ruling as authority for your position. But in contrast, a letter ruling is taxpayer initiated, and it's limited to the taxpayer who asked for the ruling. So while you may have a client who has an exact same fact pattern as a letter ruling, you cannot rely for certain that the IRS will rule the same way in your client's case as they did in the taxpayer letter ruling case. So in absence of other guidance, letter rulings can be used, but it is a subordinate authority. Revenue procedures are more of an internal management practice documentation for the IRS. It's directive, it's not mandatory. Those are published weekly. And again, if you can't find anything more authoritative, this kind of helps get you into the head of what the IRS is thinking. So if you know what the revenue procedure says, you can hope that the IRS will apply that procedure in the same manner to your client's case. Determination letters, similar to private letter rulings, are based on a specific set of facts. They're issued by the district director, and a determination letter most commonly is issued with respect to retirement plans. So if someone is setting up a new retirement plan, the IRS will issue a determination letter saying, yes, you have met all the requirements, you may become a retirement plan and have all of the tax advantages associated with that. So we've talked about legislative and administrative authority. Now let's talk about judicial authority. Of course, that means the courts. The courts have the authority to interpret ambiguous law and determine constitutionality, but courts do not make new law. They only rule when things are unclear with existing law. Having said that, case law is a tax planning resource. So Congress makes a law, it's ambiguous, the courts interpret the law, and you can use those interpretations, case law, to help craft your position when working with your clients. Something else to keep in mind is the statute of limitations. The IRS cannot pursue collection of taxes or changes to tax returns filed for an unlimited period of time. Generally speaking, the IRS has 3 years from the date the return is filed to question that return. However, from time to time, the IRS may allege that the taxpayer has made a substantial omission or a substantial understatement of income. In that case, the IRS has 6 years to make a claim or to make an adjustment. And as we've talked about before, the exception to the rule here, there is no statute of limitations in the case of fraud or if no return is filed. So that's why it's important for clients to file those returns, because that starts the statute of limitations running. You may be familiar with the concept of IRS issuing penalties. We'll talk about a few here. The first penalty we'll talk about is the failure to file. The failure to file penalty is 5% of the tax amount. It applies for each month until filed, but the maximum penalty is 25%. And this is for when a client has not filed the tax return, has not filed an extension, or we've gone beyond the extended due date of the tax return. In addition to that failure to file, the taxpayer may be assessed a failure to pay. This is 0.5% of the tax amount for each month until the return is filed. But if you're paying that failure to file penalty, then you don't have to pay the failure to pay penalty in addition. And so this is important to remember and to let our clients know that just because you file that extension on April 15th does not mean you have more time to pay taxes. So it is possible that a client files an extension in April, files the tax return technically on time in October, is not subject to the failure to file penalty, however, is subject to the failure to pay if there is a balance due, still due in October. So an extension of time to file is not an extension of time to pay, and that's why these two penalties are separate. The IRS may also issue accuracy-related penalties. This happens when the IRS believes or asserts there is a substantial understatement of tax liability or substantial valuation understatement. And if the IRS proves this, there is a 20% penalty based on the amount of taxes underpaid. So a large underpayment of taxes doesn't necessarily even have to be malicious or willful, will incur the 20% additional penalty. Now, fraud is a little bit different. Fraud is intentional, willingly, knowingly making a false statement. It's underpaying your taxes and having that intent to evade. And if the IRS proves fraud, the penalty is 15% per month, up to a maximum of 5 months, or 75% of that total tax liability. Estimated tax payments. If taxpayers do not make certain minimum tax payments during the year, they could be subject to an underpayment penalty. So what is that minimum amount? Well, first of all, it's for taxpayers with a tax liability of more than $1,000. If you have a tax liability of more than $1,000, you must pay as you go. Taxes can be paid either through withholding from wages or through estimated tax payments, checks written to the government. And that threshold is at least 100% or 110% of your prior year tax, or 90% of your current year tax, whichever is less. And the IRS will assess this penalty even if you don't. So a client who may be doing his or her own return, turning off that calculation of the underpayment penalty, will get a bill from the IRS. So just because you don't calculate it doesn't mean the IRS won't. Preparer penalties. All of the penalties we've talked about so far have been taxpayer penalties. Now let's talk about a few preparer penalties. If a preparer takes an unrealistic position on a return, you know it's not realistic that the taxpayer really drove 100,000 miles for business during the year. The tax preparer should know better and could incur a penalty for taking that position. Failure to sign the return can incur a penalty. Failure to provide a copy of the return to the taxpayer. Failure to keep copies of all returns for at least 3 years. And disclosing taxpayer information without the taxpayer's written authorization all can subject a paid preparer to penalties. Next, we're going to talk about IRS audits, something that clients are always anxious about. How do you know if you're an audit candidate? Well, there are a few ways that the IRS will pick out taxpayers for audit. The first is the discriminant inventory function, or the DIF. It's that algorithm, that formula that you've probably heard about before, where a taxpayer's tax return data is fed into a system and it's scored based on filing status, location in the country, amount of deductions. All of these numbers are fed into the algorithm, and if the taxpayer ends up being an outlier, if deductions are a lot larger for income than his peer group, that taxpayer could be pulled out for audit. Another way that a taxpayer can be pulled for audit is a related party audit. So if a business is being audited, the shareholders, the owners, the partners may also be subject to audit based on any adjustments that might be made through the company. There are targeted compliance audits. So sometimes the IRS is concerned with S corporation shareholders, with people in certain industries, with people with a certain number of losses over the years. Those are targeted compliance audits. And sometimes when a taxpayer amends a return and is requesting a large refund, the IRS might pull that for audit just to make sure that this change that they're making is well documented. Now, it may seem that the IRS has all the power, and certainly it has a lot, but if a taxpayer is audited and they do not agree with the results of the audit, there are some options. The taxpayer can ask for an internal appeal, or the taxpayer can take the dispute to U.S. court. Now, there are a couple of ways that a taxpayer can take a dispute to court. If the taxpayer uses the U.S. District Court or the Court of Federal Claims, the deficiency must be paid in advance. However, if the taxpayer chooses to use the U.S. Tax Court, the deficiency or the alleged deficiency does not have to be paid in advance. That's one of the advantages of using the U.S. Tax Court. In addition, it is a tax jurisdiction, so that jurisdiction covers the entire country, but the only thing that this tax court is concerned with, as the name suggests, is taxes. So there's some expertise there. There are two types of decisions. There are regular decisions, which are not previously decided. So these are matters of law that have not been covered before. And they are published. They are a matter of public record once those decisions are made. Now, tax court memorandums are not public record, and they are more application of previous or existing laws to a new set of facts. Now, the taxpayer could choose to go to federal district court. Again, you must pay your alleged deficiency in advance to go to district court and then hope that you get that money back. This is not a specialty tax court. It hears all types of cases, but this is the only court where a taxpayer can have a trial by jury. So if your tax attorney feels that that is something that would be advantageous to the case, then maybe district court would be the way to go. In addition, if there's a history in your particular district, because this is geographic, if there's a history in your district of the courts favoring the taxpayer's position, that might be another reason to go to federal district court. Then finally, we have the U.S. Court of Federal Claims. This court has jurisdiction over any monetary claims made against the U.S. government. Again, it doesn't specialize in tax matters. And of course, the taxpayer must pay the tax in advance. And again, if the U.S. Tax Court of Federal Claims has a history of favorably ruling on the particular issue, then that may be a reason to go to the Federal Court of Claims. So once you've gone through court and gotten a decision, it is possible to appeal. You can either go to the U.S. Claims Court, and that is if you went to tax court or to district court. If you went to the U.S. Claims Court, you can take your appeal to the Federal Circuit Court, and occasionally the Supreme Court will hear tax cases, not very often, and of course the Supreme Court has to invite you to argue your case, so not everyone has an automatic right to go to the Supreme Court. So let's talk a little bit about tax research. Tax research uses the primary and secondary sources of law to build a case. Tax practice aids such as RIA, CCH, and BNA collect reliable primary and secondary sources of information to help us build that case. Journals and periodicals are a good source of information to kind of help you understand in layman's terms what different tax sources, tax laws are saying, but they can't be relied on in tax research. And a true professional knows when to call in an expert. Sometimes, very rarely, you'll have a tax research issue where you can find exactly word for word in the law, this is a go, this is a no-go. But most of the time there's some shades of gray in there. It's a nuance. It's a different set of facts that haven't been thought of by Congress or by the IRS or even by the judiciary. And when that's the case, you need someone who specializes in tax research to take all of the primary and secondary research resources, interpret what Congress and the IRS and the courts are thinking, and build a case based around that. So it is a very specialized area of tax law, to be certain. So to summarize what we've learned today, we've identified the sources of authority for tax law. We've identified the major sources for researching tax law. We've learned about the process that the IRS uses to determine which tax returns are to be audited. And we've identified the major tax penalty areas.